Hello everyone. I've got a very important subject to discuss with you today. It's all about multiple risk-reward ratios, and I know a lot of you have already tried to understand this trading strategy, and I'm going to show you why I think this is a big myth. Okay, I've never taught this to any of my students or to my live students or students from around the world, and I'm going to show you that there are some alternatives, and also I'm going to show you the reasons why I believe this does not work. Okay, now for some of you that understand multiple risk to reward ratios, we call them R&R right here, you may think that this is part of the Holy Grail, or you may have been led to believe this by many trading gurus who will tell you to keep your trade open until you make profits of at least 2 to 1, 3 to 1, 5 to 1 risk to reward or more, right? Or I'm sorry, let's reverse this. 3 to 1, 5 to 1 being a reward to risk or more. So, for example, on a 2 to 1 trade, you make $2 for every $1 you risk, right? They tell you, don't close your trade too early. That's how you become a successful Forex trader. So, is this part of the Holy Grail? Well, guys, hello, this is me, Martin. I've been producing these weekly videos for a few years now, part of the Trade Currencies Learn Forex program, and this video I want to disclose to you what I know about multiple risk to reward ratios and why I don't really use them in my trading strategies. I do something a little bit different. So, R&R ratios, reality or myth? Okay, so the very first thing is, what are R&R ratios? Okay, we call that risk to reward or reward to risk. Either way, it's correct there. And the general idea is to set your profit target levels, a multiple of risk, to be much larger than your risk level. Now, this may sound like a mouthful, guys. I'll explain this in just a moment for some of the inexperienced traders. Your risk is the distance in pips to your stop loss. So take a look over here. Here we have a trade. You can see price has gone up, down a bit, gone up here to this level right here, and then it's going sideways down a bit, and you're thinking that price is going to go higher. Okay, you're thinking price is going to go higher, and it's going to break out over this previous high right here. Okay, so this is your entry. Okay, and you've determined, or you've calculated in whichever way that's comfortable for you, your risk. And your risk, again, is the distance in pips from your entry to your stop loss. So here's your stop loss. So from here to here is your risk, okay? And let's say that is 20 pips. So for this example, let's just pretend that from the entry to your stop loss right here is 20 pips, and then you're calculating a 2 for 1 reward to a risk ratio, and you're saying that you will not get out of a trade until you make 2 to 1. So your profit target is up here. You can see here the top of this green, okay? And this is exactly 40 pips. So from here to here, if this was 20 pips, a 2 to 1 reward to a risk is you're risking 20 pips to make 40 pips, right? Make sense? Okay, so your entry, once you enter, you're going to stay in the trade, stay in the trade until you hit your profit target level, which in this case is 2 to 1. Okay, so hopefully you understand what your profit and your risk is, exactly what they look like on a chart. Now on your charts you won't see this pink box or this green box. You're just looking at really the breakout, your stop loss here, okay, and they can be horizontal lines, and your profit target 2 to 1 in this case would be a horizontal line, okay, and you would know the price levels based on the right hand side here. Okay, so you wouldn't see the actual green or pink. Okay, now let me just take that off for a second, and let's continue. So now that you know what the R&R ratios are, or the reward to risk ratios, okay, remember the gurus are telling you to keep your trade open until you make this large reward, right? The gurus also tell you that you can have more losing trades than winning trades. Now, how many of you have heard this before? That you can actually have more losing trades than winning trades and still make money in Forex, right? Well, I'm not too sure about that, and I'll again explain why this is part of the big myth. So, this is what the gurus are saying, and let's say you're planning a 2-to-1 R&R. So I will explain what the gurus are trying to tell you, or trying to put in your mind with a 2-to-1 on this example, reward to risk, okay? And that's where the profit is twice the size of a loss. This trading strategy only requires a win rate of 33% or higher. For every 2 trades you lose, you only need 1 winner to make up for the 2 losing trades, right? So let's say you're taking 3 trades, right? And for the first trade, you lose $5. Okay, so you're risking $5 in every trade to make $10. That's what a 2-to-1 reward to risk is, right? So you've lost $5. Your second trade, you lose another $5. So after 2 trades, you've lost how much? Okay, $10, right? But on your third trade, you make, right, 2-to-1. Your trade actually is run in your favor, and you've made $10, which is 2 times the risk, right? So after 3 trades, you've lost $5 and $5, and you made $10 for 3 trades. So now you are at break even. So after 3 trades and even 2 losing trades, you haven't really lost any money, but you're break even. You haven't really made any money, and you still need some more winning trades. So, and this is part of the problem with this strategy. Okay, you will have to have a win rate much higher than 33%. Okay, but I'm going to continue, and I'll make more sense as I go along. Okay, so R&R ratios, again, the big myth. When you think about this, and I've just explained to you in an illustration, after 3 trades, you know, you're back to break even. So when you first think about this, it all makes a lot of sense, doesn't it? And if you believe this good advice, then why don't most traders do this? It's a really important question I'm asking all of you. If this is part of the holy grail of trading, according to the gurus, then what is the reality? Now, let me explain what's really going on and why this is the big myth. Okay, so the reality. Who is actually trading with multiple R&R ratios? Well, not scalpers or intraday traders. Why? Because they're just interested in getting into trades quickly and getting out quickly. They're not interested they're not interested in huge long runs, and they're interested in making money as quickly as possible. Not the mild, timid, or very cautious traders. I mean, you know who they are, and you know who you are, most likely yourself. You get in a trade, you make some money, and guess what? You're so happy, you're afraid of losing it, so you want to close the trade in profit as soon as possible. Again, you're not allowing your trade to run for as much money as possible for fear that you think you may lose that money again, right? And that's happened to all of us. We make money, we're making good money, then all of a sudden the trade goes against us, and guess what? We've lost the original amount of money we made, and often we're not careful, and we even lose more money, or it hits our stop loss, and then we're upset why we didn't close the trade when we were in profit. So next time that happens, when we go into a live trade, we're making money, we're liable to close the trade quickly, and we're happy to have made some money, okay? And that's all of us. Now, the reality, who's actually trading with multiple R&R ratios? Well, not traders with small live trading counts for sure, right? If you don't have a lot of money in a trading account, then you can't afford to lose a lot. So as soon as you get into some losing positions or trades go against you, you want to close the trades, right? And you often never hit these long home runs where the trade has gone up hundreds and hundreds of pips. Not the inexperienced novice traders. I mean, they certainly haven't even learned trading 101, right? I mean, they're happy just to make some money if they are, and they haven't really learned the nuances of multiple reward to risk ratios, okay? Not the non-trend traders. I mean, most traders are actually non-trend traders. And when you're not looking for trends, then you're looking to just get in and again make money. You may be a scalper, you may be an intraday trader, but you're not really a long-term trend trader. And only in trends are you going to get the accumulation of a lot of pips where you can actually realize your multiple risk to reward ratios. If you're any other type of trader besides a non-trend trader, that's not going to matter that much to you. Now, not the news traders. There's an awful lot of traders who pounce on the news hoping to make quick bucks, and they're certainly not looking to make their trade run because they know the trades they can make money quickly and lose money quickly in a news event. The trades can go against them in a news event. So, and finally, not the adrenaline, quick money trading junkies. I mean, they're all about just getting in, making quick money, and getting out, right? And so, if all of these people are not really using the strategies, the multiple R&R ratios, then that means very few traders are really trying to follow the advice of the gurus or the people who say that that's the way to go, right? But this is like 90% of the traders out there, and it's not a real reality for most traders, okay? Just because of who you are. Now, the problems. Now, I'm going to get into the nitty-gritty, the problems of the multiple R&R ratios. Okay. First, the large rewards, that means when a trade runs for a long way, are not really attainable most of the time because the markets do not trend most of the time. Okay? They're choppy, they're going sideways, they're going up or down and all over the place. But mainly, the markets are unpredictable and anything can happen at any time. Okay? So that's important. Gurus don't tell you that price action, patterns, the patterns that you see on the charts, trend lines, Fibonacci, and other trading strategies all fail more often than not, okay? So, that's another problem with trying to attain the elusive risk to reward ratios. The multiple ratios where you let your trade run for 2 to 1, 3 to 1, 5 to 1, and hey, I've seen the gurus show you their charts. Hey, they've had some trades run 10 to 1, 15 to 1, but I'll tell you something. They're only showing you when it works, but when it doesn't, they're not showing you the stuff that most of the time when their strategies do not work. Okay, I can tell you that for a fact. They're just showing you when it does work, and then it looks great, and you fall into that trap thinking that that's the way you have to go. Next, markets often go against you first before continuing in your trend direction, right? How many times, if you enter a trade, you thought for sure price is going to go in one certain direction, but then it comes completely against you, stops you out, and then price turns right around and goes back in your original direction. That happens a lot of times. Most traders cannot sustain the large drawbacks, because, again, I mentioned that a lot of traders don't have enough money in their accounts, and perhaps their stop losses are too close, but they cannot sustain the large drawbacks when price goes against them. Next, the number of your losers are greater than your few large wins. Okay, again, with the idea that you don't need a lot of wins, you can actually have more losers and still make money in Forex. Well, that's a lot of hogwash, and I'll tell you why, because a lot of traders, or many traders, most traders even, have losses that are far greater than their few large wins they need to make money in Forex. Next, gurus often give you blanket advice. Yeah, it's advice based on theory, on what should happen when the markets are perfect, but they're giving you blanket advice and not even factoring in your trading personality, your current experience, and your education, right? You may be a non-aggressive trader, you may be a very cautious trader, and there are different type of trading styles and different type of trading strategies, but the gurus don't often ignore all of that, and they want to teach you what they know with what they think works, but it doesn't work. It's not one size fits all for all traders. Next, you're so focused on staying in the trade at all costs instead of closing losing positions based on solid money management. Now, what this means is that you often want to stay in a trade. Trade is going up, it's in your favor, you're making money, then goes against you, and then you don't want to get out of a trade, you don't want to lose the money, then you want to stay in there. Or sometimes you're just waiting for these stupid price patterns to materialize. Like you're looking at your charts and you see a pennant pattern, or you see a triangle pattern, and you're waiting for the triangle pattern and the breakout to materialize. You're looking at head and shoulders, and the head and shoulders just never, it just goes on and on, days and days and days, and the head and shoulder patterns never materialize. Or Fibonacci, and price goes past your fib levels, and then you don't know what to do, and so on and so forth. So you're focused on staying in the trade at all costs without seeing really what's happening on the charts. And finally, you're an intraday or scalper trader, which goes against the idea, the idea of holding on to trades for a lot of pips. Okay, so these are some of the problems and the realities for trying to attain multiple risk reward. And I think you shouldn't focus on this. I think there's a much better way to trade. And remember, I'm all about stress-free trading, and it's important to not bog your mind with technical analysis and trying to figure out what's perfect in the market. There is nothing that's perfect in the market, but there's certainly an easier way to trade, okay? Now, instead, I want you to focus on this. You can only trade, or you should only trade what you see in the chart, instead of wishing for the high reward to risk ratio. So instead of waiting for your trade to materialize into 3 to 1, 4 to 1, because in the meantime it could go against you, there could be a huge drawdown, you could be losing money. I mean, instead of that, focus on this instead, guys. This is much, much more important. First, 1, look for good trade entries in trending markets. That's the only thing that really works, and you don't have to be an experienced trader. This is fairly easy to follow, guys. So trending markets is the way to trade. 2, don't apply risk reward or reward to risk levels to your trade based on theory. Okay, that's not good. So just because someone tells you to keep your trade open until you make a 2 for 1 or 3 for 1, don't do it. And there's other ways to make money in Forex without having to worry about exact levels. Next, let your trade run and stop you out with a good exit indicator. You can put an exit indicator in your chart, and when price is going in a direction, you're making pips, and only when price goes against the exit indicator, it'll tell you when to get out of a trade. I'll show you an example of this in just a moment. Next, don't focus on making decisions that can stress you out. So just thinking about R&R multiple risk reward levels, right? Like 2 to 1, letting your trade run 2 to 1, 3 to 1, 4 to 1, or these gurus are saying wait till 5 to 1, 6 to 1. Come on. There's so much stress there, and you got to watch your charts all the time because you don't want to miss out. You know, that's nonsense. You don't have to do that, guys. Next, keep your trading simple with mechanical trading strategy. So mechanical trading strategy is about mechanically getting into a trade and then mechanically getting out of a trade. And something on your chart is going to tell you it's time to get out. Finally, don't expect anything. Okay, anything can happen in the markets. We all know that, right? Instead, accept the reality of wins and losses and keeping your losses to a minimum as per your money management plan. Okay, so this is all really super important advice, and it's designed to keep you stress free. Now, the alternative, become a stress-free trader, where you don't have to do lots of technical analysis and spend lots of time reviewing your charts endlessly. I mean, the last thing you want to do is spend tons and tons of time, days on end, hours on end looking at your charts. I want you to review my previous videos. I'm going to put a few links down below this video where you can review what I'm talking about here. And it's all about becoming a stress-free trader. 2, use an exit indicator on your chart that tells you when it's time to exit a trade without worrying about these R&R ratios, the 2 to 1, 3 to 1, 5 to 1 reward to risk ratios, okay? And again, we're going to look at some charts in just a moment. Avoid this. This is super important before we look at the chart and look at a couple of charts here. Avoid seeing into the future. Try not to predict the future. Avoid guessing where price may go next. And when you try to understand these R&R multiple reward to risk levels, that's when you're guessing where the market may go next, okay? In trading Forex and making money doesn't mean you have to guess it all. Avoid price target levels that you can't see. Avoid anxiety. I'm all about less anxiety, trading stress-free. Let your trade run until an exit indicator tells you it's time to exit. Avoid price patterns and other technical analysis that forces you to keep watching your charts endlessly for something to happen, right? How many of you just keep watching your charts and you're saying, well, I'm waiting for this pennant to finish, or this triangle for price to break out at this level, or price to come down to this level? I mean, and you're watching the charts endlessly, just giving you a lot more anxiety. I mean, that's not the way to trade. Finally, avoid the gurus who swear by R&R ratios. You don't have to do that, okay? Okay, guys, here's a chart here, and you can take a look at that, and I've got one main directional trend line here. When it's green, price is going up. When it's pink, price is going down, and I'm looking only for sell trades, only for buy trades. So take a look. Here I've got an entry right there, guys. It matches with what I see down below my chart, okay? And these are filter indicators telling me when it's good to get into a trade or when to stay out of a trade, especially when these two filters disagree. This one may say go and enter a trade. This one may say no, it's not a good time. So when they disagree, I don't enter a trade. But anyways, let's say here's my trading entry signal for buy trade. Take a look. See this blue line right here? It's telling me the trend is up. It's going up. I'm going to stay in the trend unless there's a candle that closes below the blue line. Okay, there's no real candle that closes, like no black bearish candle that closes below the blue line, you see? And here, this color of this this moving average here changes color, and so right around here, that's where I'm looking at closing my first entry. So from here, I entered a trade. My stop loss was here. You can see price went up from here to here. You can certainly see if this is one level of risk right here below my stop loss, then look at this. This is right here, right here. I've already done 3 to 1 without even thinking about it. I've allowed price to be stopped out manually, okay, with this indicator, and this is just a simple moving average, guys, on the chart. So get into another trade. There's my entry right here. It confirms, go up. Take a look at this, guys. It's this line stays blue, changes color. I would probably get out below this candle. But in the meantime, if this was my risk right here, and I got in right here, right, there's one level of risk. So you can see already I've made there, 2 levels of reward. So again, this is 2 to 1 reward to risk, and then you know, and then at each level, guys, I'm taking a portion of my trade off the table, some of the profits. So if I entered a trade, let's say, just as an example, with 10 mini lots, I've taken half off here, so I've got 5 mini lot. I'm sorry, I'm entering a trade here. So here I take off 5 mini lots of profit. I've got 5 mini lots left from here to here. I've taken off maybe another 3 mini lots. Now I've only got 2 mini lots left. Price comes down here and I'm out of the trade. Take a look, guys, right here. Here's my entry. Isn't that a great signal right there? As soon as this black candle crosses the pink line, taking a look here, here's a confirmation right here below, and right here below, confirmation. Sorry, guys, it's a bit of a mess. Let me take that off. Okay, so again, entry right there. The filter for my momentum and trend indicator saying that it's okay to take a sell trade here. My money flow indicator is kind of a volume indicator telling me that there's volume coming into the market and it's a good time to take a sell trade. And take a look, guys, this stays pink really all the way here, but this white candle does not close above this line, okay? This one does, so right there you could look at getting out of the trade. But in the meantime, if you got in here, stop loss here, so here's one level of risk, right? Here is one level of profit. Here is another level of profit. It went down all the way here, so we're already in the two reward to risk, right? Okay, and then it went back. So by the time this indicator, this moving average, tells us to get out of the trade, most of our lots have been taken off the table in profit anyways. And this is what I'm saying. Let an exit indicator on your chart tell you when it's time to get out of a trade. Here you can even re-enter. It's a continuation trade, continuation all the way down. Guess what? You would have been out right there. Okay, let me take that off. You see this white candle closed above this pink line. So there, look at that. I mean, for an entry, you would have gotten in probably here or here. Stop loss right there. So there's your one level of risk. Again, here, one level of reward, second level of reward. So you would have been, most of your lots would have been taken off the table in profit before even, before price comes back here. You would have had very few lots left. And again, you would have made a lot of pips and a lot of profits. So this is what I mean by allowing an exit indicator to tell you when to get out of a trade. An exit indicator may even be below the chart. It could be something that you have below the chart, but I like something right on the chart with price. Okay, so there are just two examples, guys. This is really simple. You don't have to, and when you have something like this set up, it is called stress-free trading. I urge all of you to review my previous videos. Okay. So guys, this is the end of the video. I thank you very much for watching right to the end. I know some of you don't, but you should, because you're always going to get some really good information from me. So again, my name is Martin. Cheers, everyone. I'm a proud Canadian trader, and don't forget to subscribe. Click on the like and the subscribe buttons to get the videos to your inbox. And don't forget to comment. I really would love hearing from you. If you have anything to say, please comment below the video, and I will answer you as soon as possible. So take care. We'll see you next week, and happy trading. Bye for now.